I know you said that you liked the U.S. I know you mentioned that there's going to be a trickle down from large caps in Europe to large caps here in the U.S. Would you be buying the rally, though?
Look, if you had asked me yesterday, I would have said absolutely no. But, you know, I think there's a lot of momentum. Markets are completely ignoring Fed speakers right now. They don't want to hear it.
Are they fighting the Fed?
I think they're fighting the Fed, but I think you almost need to bring the big guns out. We need Powell to come out and speak. So until he speaks, I think the market rally can keep going. You're only about 400 points away from the previous peak. It's not that far to go, and I think momentum can take you very far. So I don't believe in the sustainability of this rally, but can it go further? Yes.
To the bond market, though, we're seeing right now, yields down quite a bit now. Excuse me, they're higher on the back end now, like 7 basis points. And I'm wondering if we're seeing money out of bonds into equities at the moment, or are we back to the whole the Fed's going to have to hike into a recession kind of thing?
I have a slightly different take on this. I think that the market is looking at the Fed and saying, look, inflation is coming down. They're not going to hike as far as they need to. Therefore, there will be no recession. And therefore, they won't necessarily need to cut rates too aggressively towards the end of next year. So I think that there is a narrative out there at the moment, which is really based on this idea that inflation, now that it's peaked, is going to come down very, very rapidly.
So don't drop your water. Alex did that yesterday. There's some
it's
sort
not
of theme
just me,
running.
Seema. Thank you. Thank you for this.
She didn't quite drop it on the floor. She didn't basically knock over an entire cup of water. Fortunately, it was pretty. No, you're fine. If Alex can do it, you can definitely do it.
Good company, Seema.
Yeah, excellent company. Are the lows in for the year?
No, not necessarily. Look, I think that once the Fed is out there, I think, look, you need to two things to be fulfilled. One is that you need the Fed to come out and say that even if, or I should say, the first thing is that you need to see growth is slowing. And then you need the Fed to come out and say that even though growth is slowing, we're still going to continue hiking. And I think once you have that, then the market will remember that, look, things are actually pretty tough. We have a very significant slowdown coming at some point, and we have a Fed that is absolutely focused on price stability. And that is a double whammy, and that, I think, is going to push markets. When that comes, is a difficult call, though.
In that environment, Seema, what do you own?
So I think this is still when you play defensive. Now, I have to say, we have stayed neutral equities through the summer months because we were concerned about a bear market rally, and that's what we're deeming it. But I think that from a fixed income perspective, you have to play defense. This is when you go into core fixed income. So things like treasuries, securitized debt. So you're taking out some of the credit element of it. And from a global equities perspective, I'm very negative on the US, I think still. But relative to the rest of the world, we still think that US can be the outperformer. But above any other asset class, this is still real assets time. We think inflation is still a problem. It's going to stay with us for a more prolonged period. So you need inflation protection, and that's where real assets still play.
So in terms of the balance within the portfolio, credit, fixed income, etc., you want to take out some of the credit risk, I hear you. But on the fixed income side versus equity side, how are you positioned?
We still prefer equities over fixed income. We can see that, during an inflationary period, typically equities can still outperform. And the thing is that valuations have come down very far in some parts of the market. So there are some opportunities, but you really, really have to be selective and seek them out. It's not as easy, Sunny, as it was a few years ago.
What perplexes me, Seema, is you sound cautious. You sound like you're aware of a ton of risks out there. It sounds like we're going to expect more volatility, but then we have a VIX at 20. And I'm just wondering how you see the volatility playing out.
So I think volatility can stay low through these summer months. It's only once the market gets that reminder of what the Fed is likely to do that's when you get volatility picking up. I think there's a misperception. I think the market is underestimating the risks out there, but they need that catalyst to remind them, and that almost has to come from Jerome Powell.
So are we just in terms of to wrap this conversation up, you're still in I'm trying to avoid losing money at the moment mode, rather than I'm trying to make money in the portfolio at the moment? Is that the right characterization?
Yeah, I think that's fair. I think it's playing defensive. You don't want to miss out. You don't want to be underweight at this point. You don't want to miss out any opportunities and kind of get caught on the other side. When it comes, when things start turning around, you want to be ready to take advantage of it, but we just don't think we're there yet. So it is about playing defense and just trying to limit the losses.